Let's talk about annuities. Have you been pitched one by a financial advisor? Do you already own one? Or have you heard mixed things about them and you're just not sure what's true? Maybe you just want some straightforward information instead of a sales pitch or some fear mongering. So I've been a financial advisor for 14 years and I can tell you I've seen every type of annuity. Some of them are good, some of them are bad. In this video, I'm going to break down the main 4 types of annuities, give you the facts about them, and tell you what's good about them and then what's not so good about them. I'm also going to break down a common feature of annuities called riders and tell you how those work. And last, I'll tell you who can actually sell an annuity and what they get out of it. So a few things first, this video isn't advice, it's just education. I'm not here today to say whether annuities are good or bad. In fact, I think that's the wrong question to ask. Since I'm an independent advisor, I also have to mention that guarantees are based on the claims paying abilities of the insurance companies that offer them, and that investing involves risk, including loss of principal. Now let's get to it. So the first type of annuity is called a SPIA or immediate annuity. SPIA stands for Single Premium Income Annuity. So if you're familiar with how a pension or Social Security works, then SPIAs are going to be very easy for you to understand. You exchange a lump sum of money with an insurance company, and within 1 to 12 months, you begin receiving income. How much you receive depends on, obviously, the purchase price of the annuity, but it also depends on how old you are when you buy the annuity, and it depends on what rates look like at the time in the market. It also depends on how long you want the income to last. So if you want the income to last for your life, or for 10 years, or for 5 years, or if you want the income to continue for you and your spouse after you die. Immediate annuities might be worth considering as a bridge to Social Security, or as lifetime income if you don't want any market uncertainty. The downside is that unless you selected income for 2, a benefit such as return of cash value or something called period certain, there won't be a death benefit. That means if you buy an immediate annuity for your life only and pass away 2 years after you start collecting income, nobody gets anything except the insurance company. There's no death benefit whatsoever. The other drawback is there's really no flexibility, so you have no option to start or stop payments, and you can't ask for your money back, unless it's within the free look period, which is typically 10 to 30 days depending on the state you live in and depending on the insurance company you buy the contract from. So that's an immediate annuity. These are the most basic types of annuities. It really is just lifetime income, and then you can throw in certain features like lifetime income for 2, a period certain, which says that if you pass away or a spouse passes away, the income will continue for a certain period of time, like say 5, 10, 15, or even 20 years, or even a refund of cash value. But in its most basic form, you can really think of an immediate annuity kind of like buying yourself a pension. The next types of annuities are all called deferred annuities. So unlike immediate annuities, you don't start receiving income right away necessarily. The first type of annuity is called a fixed annuity. If you're familiar with how CDs work at a bank, then these should be pretty easy for you to understand. In exchange for a minimum amount of money, which is typically between $5,000 and $100,000, you will earn a fixed interest rate guaranteed for a number of years spelled out in the contract by the insurance company that you purchase it from, just like with a CD. After that fixed interest period, the rate will change depending on what the insurance company offers you. Fixed annuities also typically have surrender periods of 3 to 5 years, but can even go up to 10 years. Like immediate annuities, fixed annuities carry no market risk. However, unlike immediate annuities, you actually have access to your principal. That means you can make withdrawals pretty much every single year, although this does vary by company. How much you can actually withdraw varies, but I've seen anywhere from 10% per year up to interest only per year. So one nice thing about fixed deferred annuities compared to CDs is that the interest you earn is actually tax deferred. So you can think of CDs when you purchase those, you get a 1099 INT from the bank every single year. Whether or not you take the interest out and actually spend it, the interest is taxable as it's earned. Well, with fixed annuities, that's not the case. You don't pay tax on the growth until you actually surrender the contract or withdraw the interest. But maybe the nicest thing about fixed deferred annuities is that there's zero market risk whatsoever. The principal is guaranteed by the insurance company that you purchase it from. That being said, it's not backed up by any federal agency like the FDIC, so you want to be confident that the insurance company you pick is strong and going to be around to honor its promises to you. Also, like with any fixed investment, you risk your money not keeping up with inflation as time goes on. So the next type of annuity we're going to cover today is what's called a deferred variable annuity. A variable annuity actually gives you access to investments in the market through what are called sub-accounts. So these are kind of like mutual funds. Unlike mutual funds, they're more expensive. In fact, I've seen sub-accounts where the fees are up to 50% higher than their corresponding mutual funds, even though it might look similar in what it's called. Like with fixed annuities, any growth you receive is tax deferred. But unlike with fixed annuities, your principal is not guaranteed. Because you're investing, your account principal is subject to losses in the market. Also, unlike with mutual funds that you might hold directly or in a brokerage account, if there's losses, you can't sell those and write off capital losses at the end of the year and get some type of tax deduction for that. Is not the case with variable annuities, and that's not how those work. The biggest downside to variable annuities, and probably their biggest source of controversy, is just that they can get very expensive. So I've seen variable annuities that range in fees anywhere from 3 to 5% per year in total. So these are comprised of mortality and expense fees, administrative fees, sub-account fees, income rider fees, and death benefit rider fees. The rider fees for guaranteed income and guaranteed death benefit are often 1 to 2% or even more. So again, I'm not saying variable annuities are bad. Variable annuities can actually be good for the right situation and the right person. Also, a lot of variable annuity expenses have come down in recent years, making their guarantees and their offers inside and their features a lot more appealing. So like with fixed annuities, variable annuities typically have surrender charges. The surrender charges typically last anywhere from 3 to 7 years. And they start on a sliding scale. So they might start at 8% or 7% and then go down to 6%, 5%, 4% each year until the contract is completely out of surrender. Also, like with fixed annuities, variable annuities have an annual free withdrawal amount, which is typically around 10% of the contract. So that means if you put in $100,000, that's $10,000 that you can withdraw each and every single year without paying that surrender penalty. I have seen variable annuities with no surrender charges at all. Something to be wary of is if there's no surrender charges, the internal expenses, like the ones I mentioned earlier, are often higher because they need a way to make up that difference. So the last type of deferred annuity is called a fixed indexed annuity. Fixed indexed annuities are designed to provide market growth based off of a market-linked index while preventing against losses. Unlike variable annuities, which have sub-accounts that have fees and investments that you can select, fixed index annuities are linked to a stock market index like the S&P 500 and typically have no underlying fees associated with those investments directly. So in its simplest terms, if the market goes up in a given period, your account value goes up. If the market goes down in the same period, your principal is protected. Now, that's not to say that when the market goes up, you get the same return as what the market provides. Fixed index annuities usually have what are known as cap rates and participation rates. Cap rates say that you can't earn more than a certain percent. So for example, if the market index is up 10%, but your cap rate with your contract says that you can't earn more than 8%, then 8% is all you get, and the insurance company keeps the 2% difference. Participation rates are a little bit different from cap rates. You can only earn a certain percentage of your overall total growth. If your participation rate were 40% uncapped, that means if the market is up 20%, that you only actually earn 8%. Fixed index annuities are tax deferred just like all deferred annuities, but one of the things you really have to be cautious of with fixed index annuities is their surrender periods. Some of the longest surrender periods I've seen in my career looking at all different types of annuities are with certain fixed index annuities. I've seen surrender periods all the way to 15 or even 20 years. I have 3 words when it comes to these types of annuities: avoid, avoid, avoid. But they aren't all this way. Many fixed index annuities have surrender periods of 3, 5, 7 years, or somewhere in between. And they all typically allow a 10% free withdrawal each year. Sometimes the first contract year is the exception. Also, while some of these accounts have small fees, most of them don't. The ones that do are very minimal compared to variable annuities. Now, as an offshoot to this, I should also mention RILAs. RILA stands for Registered Index-Linked Annuities. They work very similar, but unlike fixed index annuities, the principal is not necessarily guaranteed. So its performance is also tied to an index like the S&P 500. But here's where they're different. RILAs may actually have an opportunity for a higher upside than fixed index annuities due to having higher caps. However, the higher the upside, the more the potential downside risk for you. For example, you may have the opportunity to earn 18% in a given year. But in exchange for the opportunity to earn 18%, the insurance company may only offer you 10% downside protection. That means if the market is down 30% in that year instead of up 18%, you would be down 20%. So this is what's called a buffer. In our example with an 18% cap and a 10% buffer, the insurance company will only protect up to 10% of your losses. So if the market is down 30%, they're only going to cover 10% of that, meaning you still lose 20%. But a buffer is only one type of protection option with RILAs. There's also a floor where you might only be willing to accept a 10% loss. Using our previous example, if the market is down 30%, that means that you only lose 10, not 20. RILAs may or may not have fees. It really just depends on the insurance company and the product. So the first one of these I ever saw carried about a 1% fee, but then the next one I saw carried no fees at all. So to recap, these are the main types of annuities. With immediate annuities, we have single premium annuities, which start paying you right away, have no fees, no market risk, but have little flexibility. Under deferred, we have 3 main types: We have fixed annuities, which pay a fixed rate of return. They're principal guaranteed. They have no fees, but they may not keep up with inflation over time and also have surrender charges. We have variable annuities, which give you the opportunity to participate in markets by selecting investments. They defer taxes, and they can guarantee income and a death benefit through riders. But they can come with high internal fees if you're not careful, and also have surrender charges, just like fixed annuities and fixed index annuities. Then we also have fixed index annuities, which give you the opportunity for market growth, protect against market losses, and defer taxes, but their upside growth potential is capped. Then we have their cousin RILAs, which allow more opportunity for growth, but there's more downside market risk. So let's talk about riders. Two types of annuities, fixed index and variable annuities, have what are called riders as an option you can add in addition to the main contract itself. Riders have major pros and major cons. So you can think of a rider as a passenger car on the side of a motorcycle. You don't need it to ride your motorcycle, but it's an additional benefit if you want it, and it provides additional features. So the most common type of rider on annuities is called an income rider. And this functions in two ways. One, it provides a guaranteed income that grows yearly and that is used to calculate your income later. And two, it provides a rate at which you can draw income for life no matter what happens to your account value. Putting an income rider on an annuity is different from purchasing a SPIA because unlike with a SPIA, you don't actually have to give up access to your account value. The payouts for these can vary. Some of them are good, some of them are not so good. I've seen them pay out anywhere from 3 to 5%. I've seen some even lower ones that pay out only 1 to 2%. So it's important to truly understand what you're getting into before you make a purchase. So the downside to income riders is the fee that they charge. The fees are often 1 to maybe 1.3% or even more of the income base, not the account value. This is probably one of the most misunderstood things about income riders. So 1% is already kind of expensive, but imagine your $100,000 variable annuity with a $100,000 income base that has a bad year in the market. If you lost 20% of your account value and it dropped to $80,000, you'd still be paying 1% of $100,000 because that number never decreases. This is not to say that income riders are bad. For the right person and the right situation, you're still either receiving a guaranteed income or the promise for a future guaranteed income. And you're offsetting market risk by purchasing and including an income rider on your annuity. Also, unlike a SPIA, you have the flexibility to access your principal and start and stop income later. So the other common type of rider with annuities is called a death benefit rider. It's a guaranteed payment paid to your beneficiaries at your death. Typically at a minimum, the death benefit is the amount you originally invested less your withdrawals. Your death benefit might also receive annual increases if you didn't take any withdrawals. As far as fees, I've seen death benefits range anywhere from 1/4 up to 0.6%. Why 0.6%? I don't know. It's insurance companies. But they vary in price and features depending on the insurance company you use, just like all variable annuity ins and outs and features. So just keep in mind that the more the insurance company could potentially be on the hook, the higher it's probably going to cost. So let's talk about who can actually sell you an annuity. So the first thing to know is that not every advisor or insurance salesperson can sell every type of annuity. Immediate fixed and fixed indexed annuities can be sold by any person that gets a life insurance license. Getting that license means passing a background check, taking some state required classes, and in most states, completing a 4-hour mandatory suitability training. When someone sells you one of these annuities, they are typically paid a commission by the insurance company. The commission is most commonly in the range of anywhere from 2 to 6%, and it could be a little bit more, especially for those longer surrender period annuities that I mentioned earlier. But keep in mind that this commission check is from the insurance company, so you're not paying it actually out of your investment. So if it's a $100,000 annuity that you buy and the insurance company pays a 2% commission to the salesperson, $2,000 is paid by the insurance company, but you're still fully invested with your $100,000 on day one. Variable annuities are different because they mix insurance and investing together. To sell a variable annuity, someone has to have a mix of both life insurance licenses and investment licenses. They also need to be connected with a brokerage firm. The insurance company still pays a commission when these are sold, and oftentimes the commission payout can be even higher than with fixed annuities, sometimes between 4 and 7%. Plus, the agent might receive smaller ongoing payments each year. Now, here's something most people don't know. Some insurance companies set minimum sales requirements for the agents that they work with. In other words, the agent has to sell a certain amount of annuity business, life insurance business, or a combination combination of the two to keep their contract active with that company. That doesn't mean every agent is under pressure to sell, but it does mean there can be incentives to recommend certain products more often. The bottom line is this: if someone is warning you away from annuities, it might be because they don't have the ability to sell them or work with them regularly, or it might just be because they don't understand them. If someone is encouraging you to buy one, it might be because they get paid to sell them, and it might even be because they have a sales quota they have to meet. Neither of these things automatically makes annuities good or bad, but it does explain why the opinions around them can be so extreme. This is not a knock on advisors or agents that sell annuities. They can be a good thing, and they do have a place in the financial services business and the financial advice business. So don't think that your agent necessarily does not have your best interest at heart because they're recommending a certain type of annuity. They very well might. So we talked about annuities, income riders, commissions paid to agents. At a high level, just keep in mind that annuities are a tool. If anyone is telling you that they hate annuities, run away from them. Why would you hate a tool? Tools are only bad when used for the wrong purpose. Since annuities can provide guarantees for interest, for income, and for a death benefit, and are tax deferred, and even bypass probate at your death, they can be not just the right tool, but a great tool. Lastly, remember when it comes to annuities that it's not all or nothing. You can use an annuity as part of your retirement income strategy, kind of like buying a pension, but not use every last dime of your retirement savings to get one. At our firm, Providers and Families Wealth Management, we're an independent registered investment advisor. We don't have sales quotas. We don't have misaligned incentives. Our responsibility is to the client and no one else. If you're uncertain as to whether an annuity is right for you, we would love to chat. In the description below, there's a link to schedule an absolutely free, zero pressure consultation. If you enjoyed this video, please don't forget to like it and subscribe to my channel for more clear retirement planning content. Thank you so much for watching today.